Assalamualaikum warahmatullahi wabarakatuh. First of all, let me introduce myself. My name is Diah Ramadhani, student ID number 2341-2060 from Kelas Akuntansi 23A. On this occasion, I will discuss the examination of long-term liability, a crucial part of a financial statement audit that focuses on a company's obligation maturing in more than 1 year. Examination of long-term liability is crucial because this account often involve significant amounts and directly impact the company's capital structure. Mistake in recording or disclosing long-term liabilities can mislead a user of financial statement regarding the company's financial position and ability to meet its future obligation. According to BSAK 1, long-term liability are obligations that will not be settled within 12 months after the reporting period. Types of long-term liability include period payable, mortgage payable, long-term bank loans, finance leases, and employee benefit obligation. These liabilities are generally used to finance a company's long-term investments such as the purchase of fixed asset or business expansion. Because of their significant value and long-term duration, auditor must ensure that their recognition, valuation, and disclosure are carried out correctly and in accordance with applicable accounting principles. The primary objective of the long-term liability audit is to provide assurance that all long-term liability actually exist, are borne by the company, are recorded at a reasonable amount, and are appropriately disclosed in the financial statement. The auditor also needs to ensure that the classification of short-term and long-term liability is correct and that related interest and amortization expense are recognized in the appropriate period. In other words, the objective of this audit is to ensure that the financial statements accurately reflect the company's liability and do not mislead users. In conclusion, an audit of long-term liability auditor performs several important procedures. First, auditor examines the loan agreement document to understand the terms, conditions, interest rate, and payment schedule. Second, auditor confirms with creditor or financial institution to verify the outstanding balance and compliance with the agreement terms. Third, auditor assess the calculation of interest and amortization of discount or premium to ensure that interest expense is recognized using the effective interest rate method. 4. Auditor review the repayment schedule to ensure that the portion due in the near future has been correctly classified as a current liability. Finally, auditor review disclosure in the notes to the financial statement to ensure all material information such as collateral, interest rates, and maturities is present transparency. Auditing long-term liability presents several challenges that require vigilance. First, the completion of debt agreements can lead to miscalculation, especially if there are variable interest clauses, grants, or restructuring requirements. Second, there is a risk of misclassification between short-term and long-term portion, which can impact the analysis of the company's liquidity and solvency. Third, auditor must be aware of potential covenant violation, which could change the status of liabilities from a long-term to short-term. Furthermore, auditor need to be aware of the potential for undisclosed contingent liability, such as a loan, words or deferred contracts that have not been present in the financial statement. All of these factors require auditor to have a thorough understanding of the legal and financial aspect of each long-term debt transaction. In conclusion, the examination of long-term liabilities is a crucial process in a financial statement audit to ensure that all long-term liabilities are fairly recognized, valued, and disclosed. 12. Procedures such as refining debt agreement, confirming balance with creditor, verifying interest conclusion, and testing liability classification. Auditor can provide assurance that the financial statements accurately reflect the company's financial condition. Given the complexity and material impact of the accountant, auditor must be professional, skeptical, and tough to detect error and potential fraud. Thus, audit results and enhance the credibility and reliability of the company's financial statement in the eye of stakeholder. That's all the material from me. Thank you. Wabillahi taufiq wal hidayah. Wassalamualaikum warahmatullahi wabarakatuh.